Welcome to Own Your Zone podcast, where we feature venture capitalists, innovators, angels, and other investors who create positive impact globally. Now, let's get started with the show.
Hi, I'm JiNan Glasgow George. I'm a patent attorney and founder of Neo IP and Patent Forecast. Neo IP is a law firm that helps clients maximize their return on investment for patent assets. I'm also host of this show where we feature venture capitalists, private equity and angel investors, and innovators making positive impact in the world. This episode is brought to you by Neo IP, where we help companies increase valuation and protect their business through strategic IP protection. We provide legal services that help companies develop strategic assets and monetize them in connection with their business. We also help innovators impact society for good by transforming ideas into assets and connecting innovators to resources they need. Thank you. I'm so excited today to have Buda, who is managing partner of the Aware Fund, to join us. She is definitely impacting society for good in many ways, more than you can imagine. Welcome, Al. Good to have you on the podcast.
Thank you so much for having me, JiNan. I'm Buda, as you said, managing partner and founder of Aware Partners. And before we jump in, I'm going to show you that it's possible. Here is the newest venture capitalist in the room who just turned 3 months old yesterday, my second. And so for all of you who are thinking whether it's possible, I'm telling you, it is possible.
Lovely.
And it probably influences a lot of my long-term thinking, because what I do here today, I'm fortunate enough that I don't have to work anymore. I chose to do what I do. And this fund is my love letter to Albert and his generation. So just wanted to inspire people before we jump in. Thank you so much.
Fantastic. Yeah, welcome, Albert, to the podcast. So beautiful. So the first mom to bring a child onto the podcast, and welcome that. I will just say, as a nod to it, because of owning my own IP law practice, I was able to have both of my children, my son Gaetano, my daughter Rosa, to join me at work, and then move on to kind of the schooling and life that they now lead, and they're in their 20s. So it is more than possible, and we're teaching them global impact at the same time. So applause to you again, Al.
Thank you.
I will say that
I'm all yours. I would love you to direct us. So please maybe give us a little roadmap for the next for this podcast, and then we can dive into the first section as well.
So first of all, I would say that at the time that I met you, like having you on the podcast was a dream, because you have made such impact already with innovators, with investment, your time at Oxford Accelerator, et cetera. So I would love to have you tell your story. I would love to have you talk a little bit about the point of view you have on unicorns as a broad trend, and then also intellectual property and data and any other mega trend that interests you, because that will interest us and all the people who listen.
Love it. Okay, so we'll do the person, we'll do unicorns, and we'll do trends. It's extremely clear. Okay, the person. So I'll give you the tweet-size summary for everybody out there. I've been a quant, an engineer, an entrepreneur, and an investor over the past 20 years. I founded and exited 2 profitable SaaS, software as a service companies. I was an engineer and product person at PayPal and Google, and president, as you mentioned, of the Oxford University Startup Accelerator, out of which 19 unicorns have emerged. And really, that's where I started angel investing and what put me on the map, so to speak, on the VC side of things. I can't actually talk about the current fund because we are still we have to be in stealth mode because of SEC rules and solicitation rules. But across the founders and advisors, we have done 600 individual deals, and there are 59 unicorns in that, 10 IPOs and 2.3 billion in M&A. So I feel that I'm very passionate and I'm uniquely qualified to talk about not just the technology, but through the whole life cycle of both the founder's journey and now the investor's journey. And maybe just as a little background, I would like to say I'm Hungarian by birth. I was brought up in Hungary, the Middle East, and China before coming to the US. I lived in 8 countries and speak 14 languages, but most of it is actually my own doing. People often assume it was my father or something like that, but unfortunately, he died when I was 4, and I have overcome tremendous childhood poverty to the point of in Hungary, we had to choose between heating and books when I was little. And I often chose books. Not many people know this about me. And eventually that led me to a full scholarship to Harvard and being a top scholar in Oxford. So I'm a product of what can be done if you have the aptitude and are willing to have the attitude. Yes. And I'm very passionate in giving back and making other people also to live into their potential through giving them resources and education and knowledge. And so this is why I'm doing what I'm doing, because I hope to create these opportunities around the world for others as well.
I love it. And so amazing. I mean, it's part of my, I guess, ethos and part of my courage in the world, creative courage, is that we have an unlimited resource of ideas. But it takes some work and action to transform them into assets and into impact. And you've done that. So maybe let's step a little into the work you did at the accelerator, because I mean, the track record is incredible. What was happening at that time and what was extraordinary in terms of the way you approached that?
Well, Oxford and also perhaps other universities of higher learning of such caliber have the tremendous advantage of the intellectual capacity. Oxford specifically, therefore, was a very lovely mixture of both what I would call idea-led and deep tech-led startups. So there were a lot of business school students who had experience and who were smart, or even undergraduates who saw a problem and went at it, solving it, and wanted to build scalable companies to solve it. And there was also a lot of deep tech, where the university labs in physics, in chemistry, and biology were used and were spun out. Perhaps a little different from the US ecosystem. UK is very, I use the word federated, meaning every school in Oxford has its own process, has its own budget, has its own approvals. Unlike at Harvard, where everything was extremely centralized, we had a lot of freedom and therefore sometimes frustration as well to try new things, but also a bit of more conservatism in Europe. Specifically, I want to maybe just mention something around the unicorn generation trends of our world that I've seen. So if you look at the data, there are now 1,200 plus unicorns or companies with $1 billion plus valuation. But most of these companies weren't even there 5 years ago. So there were only about 300 5 years ago. So what you're seeing here is that there was an acceleration over this last period. Now we have a bit of a correction. So I'm sure we will see a little bit of contracting, but the feeling is, I think, and there's a consensus that value creation is speeding up, and therefore we're going to see more unicorns faster at larger and larger valuations. I'll give you one example. There is a very interesting data analytics company, and I have this in my special report, that in just 3 years' time achieved the unicorn status. In fact, they have they raised at a 1.5 billion valuation in their Series B, with just 52 employees, in 3 years. And this is unheard of. Like, you used to have to wait, 5 years, 7 years or more on average there are some exceptions, but it used to not be possible to do this at the Series B even. And so I think we're going to see more and more of the real winners, the people who hit the hockey stick, come in earlier and earlier into that unicorn and maybe decacorn even echelon. And actually, I'm very bullish. I know it's hypey, but you asked me about trends. I think it's hypish what's going on with the AI. But if we just step back one step and you ask me, what could we see from an accelerator's perspective, where you see you have the benefit to see a whole portfolio of amazing people. If you step back, the basic economic principle is productivity creates value. And if we increase productivity, we can create value. I think that this current generative AI has unlocked and is unlocking levels of productivity that we have not seen before, at a cost so low that we have not seen below. And whenever something like that happens in an industrial revolution style thing, the value creation potential is beyond of what we can imagine. Mm-hmm. So I think what we're going to see in terms of unicorns, we went from 300 to like 1,200. I think that number is going to be, in the thousands within, the next decade, I'm hoping. And my vision personally is to generate 100 unicorns over the next 10 years personally through our fund.
Love that. Love that. And I know all these things look forward-looking statements, but at the same time,
yes, correct,
the factors are coming into play, right? So can you share a few of the factors that you consider most important for achieving unicorn status? I know that they have commonalities. We'd love your point of view on that, Al.
Actually, there's a precursor to the becoming a unicorn, which has to do with the asset class and how venture capital has changed. Would it be okay for me to give that background and then go into the asset level? So what I'm going to do is kind of answer another question before I answer the question. So the way I think about this is there is the market level problem, or portfolio level, if you want to think about it. And then there's the startup level, which is the actual unicorn growth. So I do want to just click very briefly on the market. Historically, 20, 30, 40 years ago, companies that are today Series C size roughly, would already go public. The average age to go public in 1999 was 4 years. So you would have these fairly young companies going public and allowing the public to capture the value that is created in their growth. Yeah. Basically, public markets were growth equity. Today, this has largely moved to the private. So it now today in 2022, the average time to go public is 12 years, and the valuation has, I think, about 5x. So the public has sort of slowly been squeezed out of the initial value creation. And therefore, I think it is no surprise that more and more institutional money and also personal money is coming into venture capital. This does mean, therefore, that being connected and the personal networks of the founders and their investors actually, I think, has an outsized impact on whether a company can become a unicorn or not. Because unfortunately, you need to be able to get onto the radar of those select few people who can write a $200 million check to get you into $1 billion valuation. Because so there is, I think, a shift towards private markets. It has benefits, but it also has this side effect that for the founders, it means you do need to be plugged into the network. Of course, if you have an amazing asset and you've built an amazing company, you're not going to have any problems. So that's the underlying. Now let's come to the startups. There's lots of things I could say. Between you and me, we've discussed that the two things that founders cannot get wrong, because they are irreversible mistakes, are their securities and their IP. If they shoot themselves in the foot with that too, no matter how much value they create, they won't be able to capture.
Yes.
It's true. So we will click. I think we'll continue with, because you're an IP expert, I'd like to have the discussion with you here. We can never hear enough about it. The other issue is good founders have many I have quite a long sort of due diligence process that I take my founders through, and I often have the feedback that we force adult educations with the founders, and even then things can go wrong. What do I mean by that? The skill set that you need to set up lots of hypotheses and iterate is very different from a skill set, for example, to fine tune and optimize levers of revenue. It's a very different skill set and sophistication. That said, this can all be learned, and there are now more and more best practices and blueprints. No matter what, I would like to say that from the startup's perspective, historically speaking, the best VCs that I work with, for every 1,000 company they look at, they will invest in about 10. And they need to invest in about 100 companies to have one huge breakout.
The power rule, right?
This is the power rule. Yeah. So that means that you practically, like for 100 unicorns, let's say, we need 10,000 startups. And those are investable startups. Okay. Yeah. So this is already beyond the, hey, I'm just an idea. This is, I have some early prototype, maybe some traction. I understand this industry. I have a team, like it's an investable little package. So it's possibly another factor of 100. So we're looking almost 1 million people have the idea, and there's going to be one unicorn. That's why it's called a unicorn. It's so hard to find. To close this up though, I will say, like you said, ideas are the unlimited. I love this as you say it. Ideas are the unlimited resource of human genius. And then to translate that into value capture, that is the goal of both the founder and the VC. And the IP, which is why I'm so interested in and excited to work with you, sort of IP is the path to turn the ideas into assets. So I'm happy to come back to that, and then we can talk more on how do unicorns and others should handle their
I love that. Thank you. And so much content there. I mean, that was so much captured in that segment. Thank you. But you're right. There's only two things that you can really do wrong in the early stage that you cannot correct, and that is patents and securities, right? The intellectual property and securities. Why don't more founders think about that as top priorities? Or maybe they do, but just there are so many that don't. We see that.
Okay, if I tell three cautionary tales that I always share with my founders for the benefit, I hope you have some founder, maybe even it helps VCs and angels. I'll give very short 3 cautionary tales. The first one is, the first 2 are about securities, specifically about safe notes. Safe notes are extremely popular, and actually one of their creator, Adeo Ressi, is my core advisor. He actually is more than that. He's basically our core investor and staked our GP, and through VC Lab, we are part of his I would say, his closest circle. But so the safe notes have been now abused in the sense of, I would say, originally they were created as a short, cheap, almost free way to raise funding instead of convertible notes, just to get people over to a first price round. But because of their ease of use and their publicity, and because, of course, Y Combinator using it, it became popular and trendy, and people are using it without understanding of what it's doing. And usually it's these kinds of cases that shoot people in the foot. The first problem was, I've seen a case where the founders were actually good at fundraising in that they had good pitch and they went out and they got a lot of safes. The problem was when it came down to unwinding the whole thing, they were only left with 9% equity. They didn't realize by the time they got to the funding round that they owned almost nothing. And from the investor's perspective, suddenly this was an uninvestable company because there was not enough alignment to see the founder through to an exit, and there was too much of a risk that the founder will leave, right? Yeah. So they had the good idea, they had the good market, they actually did the fundraising, they did all the hard work, and there was just no understanding of what a cap table is, because safes are there's the pre-money and the post-money version. Now it's the post-money that's used, but actually I often, if needed, I prefer the pre-money, which is now not what Y Combinator uses. So there is this kind of first case. The other case that I see sometimes is a little bit similar, not this bad, but basically they kept raising another company. They kept raising on safes, and when it came to unwind it at their first price round, it got so complicated that it drew out the process so much that most investors left and the deal fell through. Oh. What happens is between caps and no caps, between who was offered what cap and what favorite clauses and whatnot, it became sort of a mess and a finger pointing of why did they get this and I didn't and whatnot. And also the cap table was so complicated they couldn't quite. Some people say it's so easy to figure out, but it's not. There were too many players in the game. And so why did this happen? I believe because if you have a price round, so you actually have a valuation, even if it is, forward facing or if it's based on milestones as opposed to revenues, it forces a kind of adult conversation that a lot of people are just not ready to have. And so they do this safe thing, they kick it down the road and they don't consider the effects. And so I have a lot of conversations with founders around, let's have the adult conversation of what valuation, what is fair to you and the investor. And if we can, let's buy the bullet and the cost of the price round. And I know this is not what a lot of people are doing, but this is how we're able to ensure that it keeps and it remains a very investable solution. And then the third one is actually your story. And I would like you to tell me if
I'm sorry, we dropped out there just for a second, but I caught all of that. Thank you. Thanks so much. I think
the third one is actually yours. Maybe you could share it. Being one's prior first art is probably the most common problem that I see in tech companies.
It is.
I would love you to tell the story because it's very preventable, but absolutely crucial.
Yeah, it surprises me so much that there is an inertia with startups that isn't the business, but is their willingness or their openness to consider how and when to invest in IP assets. And the thing about patents is you can't go back and do it later. So the exchange, the reason we set up the patent system in the US and globally in many countries in the first place, is this exchange of what is otherwise private, confidential, trade secret for exclusive rights. So you have to disclose what you're doing before it's in the public domain. And I think there's a misconception across founders, especially in tech, that they can do it later. Wait until we've raised a certain amount of revenue and then we'll patent it because it's expensive. And yet you can't move back the clock. You really have to file first to keep your options open. And there are cost-effective ways to do that, but it surprises me. Also, this misconception of software patenting, like software not patentable, or maybe many in software don't want to patent. They think open source is free of IP, when in fact it's the opposite, right? So open source has very rigorous copyright controls and agreements. And when we think about patents in software, in the last year, 2022, 65% of all patents in the US were software-related inventions. And big tech, big software, they're filing at higher levels than ever before. So if everyone else thinks that it's valuable, but as a founder you don't, stop and think, talk to your investors, and I think give a look at what's happening in the market where you want to be. It's like skating where the puck will be in hockey, not where it is. You have to get ahead of it. So yeah, an important question. And I think an important cautionary tale to founders to consider IP early and to revisit it.
I will double click on what you said, translating this to investor terms for founders and investors. I actually have a negative screening in place for not just the IP, but also the product roadmap. If we think that the company's product could be developed as a feature of a large incumbent or adjacent closely enough to that, it's a negative screener for us. And I have seen it. I have fortunately not invested, but I know personally founders who came up with the idea from business school, built it, even won some business school competitions with it, got to revenue, and 3 months later, it was a diabetes diagnosis, sort of self-diagnosis company. 3 months later, the incumbent came out with a feature and a device, and they were obliterated completely. And so it is so important for startups also, because if you do want to get to the unicorn stage, it's very often not enough to have just one line of business. And to survive that initial stage, as you said, it's not that you cannot kick it down the road. It's almost like absolute necessity from a life perspective. And so I think VCs and micro VCs, this is a trend that we are seeing as well. New venture capital firms and angels are entering the space, which I think is wonderful. It does mean, however, that perhaps the experience or the sophistication from a legal perspective and a strategy perspective is not there, because they might be expert in a domain or they might be expert in a technology. And so these learnings will have to be learned. And I think you and I are here on a mission to give these blueprints to people so that they can know what they didn't know and have the blueprint in their hands.
Yeah, absolutely. And to wade into it. It's not a deep dive commitment up front, but to do Correct. A quick SWOT on IP diligence for funds, for companies, to be able to do that very quickly in like a day or 2 days, very cost effectively. And then to be able to rely on that to say, yes, this is an indicator that we have opportunity. And if we have delayed in something, that there is still opportunity or not, like gives very quick feedback. It's like the vital stats for any company that I think venture should want to consider in a way that's more important than ever before, because intellectual property and innovation, as you mentioned, it's accelerating. Unicorns accelerating in this age of AI. And so the need to, I think, do this with thoroughness and accuracy, but quickly and concisely early is a big deal. So we're in alignment on this idea of quick SWOT early for diligence on IP, and be sure to correct it early. If you cannot totally fix it, at least make corrective action, because it's the fate of your company, right? I want to get in data if you have a couple more minutes, because
yes, I wanted to talk about 3 trends that I see that I think are people, even sophisticated investors and LPs have blind spots to. Is it okay if I bring those up that awesome. I see? And it's not actually AI, because I take it as a given. I want to talk about 3 things. I want to talk about volume. I want to talk about globalization, and I want to talk about demographics. So let me break down those 3. Volume. We talked about the acceleration, and it's related because it's never been cheaper to start a startup. Yes. Now at Google, when we started as an ex-Googler or Xoogler, we had to buy and build our own data centers. There was just no other way. There were no cloud providers. Nowadays, $5 or less, sometimes even free, you can, get started. This will create tremendously investable, good, specialized niche products that are very scalable very soon. We've never seen this before. We don't even know what's coming, is my feeling. But this means that we are seeing thousands of new funds and potentially, I think, millions of investable opportunities per year come up as people mature into education roles or have the educational attainment to use these tools, basically. this will make it, I think, impossible to do manual due diligence and in the first round. And so I'm very passionate to build data warehouses that underlie our fund. And I can't talk more about it, but this is my idea, that it will be impossible to do business the same way as it was, or it will be possible, but it will be ineffective, and you cannot be sure to win. So I hope that people are considering volume. The number 2 is globalization. So PricewaterhouseCoopers has the excellent data set called The World in 2050. I will just highlight the things that really struck in my heart. First of all, by 2050, the United States will only be the 4th largest economy. If you want to think about it, it will be China top, then India. And if you didn't know this and you don't follow it, Indonesia will be the 3rd. It will eclipse the US. So in our children's future and grandchildren's future, the United States will only be around the 4th. Not only that, but Europe as a total will represent less than 9% of global GDP. I just want to say that one more time because I'm European. Europe's total GDP will represent less than 9% of the world's GDP. There are so many sophisticated players, pension funds, and large LPs, I think, will have to survive to 2050. And I'm not convinced that they understand that them being concentrated in Europe and US is going to cover the actual needs and the growth opportunities of the world. So, for example, my older son, who is 2, is now fluent in 4 languages. I'm sending him to a Mandarin daycare. That's their world. It will be different from today. So there's globalization. And the third one is demographics. Even in the US, we know that by about 15 years' time, the white population will be outnumbered. So it will be the Latin American and other, what we call today, underrepresented minorities will actually be majorities. Then they will be educated. And if I may say so, I will pause my thought and then I'll say it again so you can cut it. But the demographics of both the creators and the consumers is going to radically shift away. And it will take maybe 10 years or 15 years for this to mature into company outcomes through revenues and pricing. But I think right now people are investing in these more out of the goodness of their heart, or they're doing it more of an impact focus. But what I think is that this is where the population and the talent is going, and where the innovation engines are going to continue to come from. And it will be a very different demographic. And so these 3 trends, I think, are worth of studying from a data and allocator perspective as well.
That's so interesting. I want to press a little into that. In terms of the creator plus the consumer, I definitely have read or understand from the consumer standpoint by population and growth of affluence, et cetera. But talk about the creator side, because I think the education systems by country, like China, India, I'm not familiar as much with Indonesia, but China, India compared to US or Europe, the education systems perhaps have in the past been labeled as not creativity reinforcing. Do you see that as something that has changed or that people aren't as much aware of?
It's a very good question. Education is actually very close to my heart. I agree with all that you said, but it's a yes and. So yes, maybe the Indian one I don't know, but Chinese education system I can speak from firsthand experience is not focused on critical thinking or debate and higher order work. However, it is extremely rigorous, and I think a lot of people in the West don't quite understand what a Chinese work ethic looks like until you actually meet it. Like we don't have a concept of what people are capable of there until you live it. As an Eastern European, I have some idea because we had some of that. And the reality is China has already over eclipsed the US in terms of innovation. This is already passed. It used to be the case that we would see the Chinese come to the US and then go home, right, and build the equivalent companies at home. That's already over. Now they are doing things where we should be going over there and copying their business models if we could. Their business models are more novel. The way they are willing to use AI. Frankly, the fact that privacy is not a, what's nice ways to say it?
Not a value.
But they have paths. Yeah, they have paths ahead of them that are not available to us. So from an innovation perspective, they have the US. I think we are now the Roman Empire here, sort of looking outside and thinking that we are the great. And this is China's education system and their innovation ecosystem, I think, has already gone. We have to play catch up. India is interesting because it's so large and so troublesome. And Indonesia is coming. It's yet to be seen of how stable they are and how well they do it. But we have the model. For example, Singapore has proven the model that social change comes before economic change. You know, they've instituted tremendous social change, healthcare and education. They doubled down on their knowledge work, and they've turned really a swamp into an economic superpower. And I think Indonesia has this path open to them. And it's my wish and my blessing that they are able to execute well on it.
Wow. These are very great futuristic observations. And we thank you for sharing the vision, Al. I mean, that's incredible. I want to respect your time. Do you have 2 minutes before we close? Talk a little bit about data and AI. What excites you and what scares you?
Interesting. Well, currently, I on the horizon, I'm waiting for breakthroughs around semantic understanding. So in AI now we have tremendous generation, but these tools that don't actually understand us, so to speak, they are pretending to. They're extremely smart parrots, so they can parrot very plausible things back to us. For example, the case of the lawyer who wrote their case with ChatGPT. And it generated in the brief, cases that didn't actually exist. And the person didn't realize that there's no fact checking behind these generative models. So I'm really waiting for breakthroughs sort of on the semantic understanding and how people are layering the use cases that are tolerant or even welcoming the generative aspect and the non-deterministic aspect, meaning every time you generate, you can get a slightly different answer versus the factual based. I'm also very interested in seeing spaces of how to apply this to private or non-shared data sets. So how to combine the models while maintaining and limiting access on a granular level to people's assets. From a data perspective, it might be obvious, but being in the private market, there is very little transparency still on the startups themselves and the funds and the flow to investors. And I'm very interested in seeing how the transparency will grow from a simple. Well, it's simple, but it's very proprietary, so people don't want to share it. On how we're going to dance this dance, the more transparent we can be, the more capital markets we can pull into the industry. But it's harder to stay stealth, and so it has some side effects. A lot of people say the industry doesn't want it, and I'm very interested in seeing how internationally new data sets are emerging, and I'm at the forefront of it. On startup investing, so that we can start benchmarking performance and cost of revenue and cost of growth for the same industries in different geographies all around the world. So right now, these are sort of my focus areas.
New spaces, lots of opportunity for sure. Al, I want to thank you so much for joining us today on the On Your Zone podcast.
I want to do a 2-minute thing for you as well. So I was so inspired actually by your book, The IP Miracle, and I'm going to share my screen and actually show it here. I hope that's what I'm sharing.
Yeah.
Am I sharing my Amazon page here?
Sure.
That's the miracle. Now it is a required reading for my founders and GPs because I'm actually a fund of funds. And we are putting together a special report that's going to be sort of the light version of our sort of unicorn miracle, or I call it the unicorn blueprint. And for investors, the unicorn investor special report. So if it is possible and if it's meaningful to people, the first step here is I've created I'm going to share the, okay, the first step is, for those who are interested, we're going to share a self-assessment. It's basically a scorecard that investors can score themselves on these trends and sort of asset allocations that we talked about.
Yeah.
And they can also pre-order our book.
Thank you. Thank you. Fantastic. And
actually, I would love to give away, maybe when the book is out, can I do a follow-up with you? I'd like to do maybe 100 book giveaway to your podcast and your newsletter. What do you think?
Thank you. Oh, we would welcome it. And I love the work that you're doing. And I would just say to applaud you as a leader in global innovation, investing impact from the standpoint of unicorns make more impact. And how are we supporting the next generation of innovators, entrepreneurs to strive for that? It's not a moonshot in terms of the stats. I think it is equipping and executing. And I think the encouragement, there is an emotional factor to unicorns, right? And so I applaud everything that you're doing, Al. And how can people find you online? Where would you like people to reach out to you, through LinkedIn or through other means?
LinkedIn, Al Buda is the best. I welcome inbound at all times. And actually the scorecard itself is the best because that way we can have a meaningful conversation. So we have a scorecard for investors and we have sort of scorecard checklist for founders and GPs as well. We're always welcoming inbound inquiries.
Thank you so much. Thank you so much. And we look forward to having you back on the podcast. Thanks, Al.
Thank you for listening to the Own Your Zone podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.